Do you want to buy a property but don't know what paperwork you actually need to organise prior to consulting a broker? Hi, I'm Jaryd Krause.
And I'm Sam Powell, and we're the hosts of the Property Pals Australia. And in this episode, we're going to be discussing what is a pre-approval and the importance of it, what paperwork preparation that you need to start sorting out before you speak to a mortgage broker. It's really important.
We're also going to be discussing what is a credit score, how it actually affects your borrowing capacity, and how you can improve your credit score and go away and check it for free. So we've got some great resources towards the end of the episode. So check out those links. There's so much value and stories that we share throughout this episode that I think you guys are absolutely going to love. So let's dive in, Sam.
Yeah, stick around.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Let's do it. Property finance preparation prior to pre-approval. Say that 10 times fast.
All the P's, property finance preparation prior to pre-approval. There we go.
Yeah, I know. What is pre-approval? So on this episode, we basically want to help people to understand how to basically get pre-approval. But what is even pre-approval?
Yeah, look, everyone goes out to buy a property, not to get finance. So
goals of property, not just finance. That's a step, right?
As I said before, we jumped on the episode. It's just the biggest barrier, which is finance, because everyone wants property. It just being able to buy the property most of the time takes leverage, and that's borrowed funds. And what we need to do in that stage is basically put our best foot forward to get those funds approved. Now, I'm not a mortgage broker. I work with a lot of Australia's top mortgage brokers, and basically all the deals that I've done in my life, I can see the importance of having good advice. But I guess the step one here is to really understand what pre-approval is and how to get it, because so many clients have come to me saying, "Oh, Sam, I want to buy a property." I'm like, "Fantastic. Do you have your savings?" "Yes, we've got savings." "Okay, well, what's your borrowing capacity? What's your I guess, purchase goal here?" And often they're like, "Well, I don't know. I've got a couple of grand and I want to buy a property." I'm like, "Well, let's get you in." Basically, that's like step one, and then they get into that. Look, I just guide them through that process, and what we're going to run through today is just the simple guide that I get people prepared for to put their best foot forward. So pre-approval, what is it? It's pretty much what it says on the box. You're getting pre-approved for a loan, and your mortgage broker does do that. Why is it important? It's like going shopping without any money in the bank, in a way. Like
it's like clarification or confirmation that this is what your borrowing capacity is, and that's settled because the banks literally said, "We're going to approve you for this amount of money," right?
Yeah, and it's giving you a framework as to what to look for, so you're not wasting your time. It's a big thing that people don't understand, is that they might think that they can afford an $800,000 house, so they run around looking at $800,000 houses. Some people even bid at auctions, which is super scary. And other people's, putting offers on properties subject to finance, and then they go through all that time and expense. And often with purchasing properties too, there's like cooling off periods. But in Queensland, we've got a 0.25% fee if we don't go through with that under the cooling off period. So it can cost people thousands of dollars for this one mistake. So that's why I thought it'd be really important to get this episode out. So that's what a pre-approval is. And what I'm going to talk about here is basically how to get your pre-approval, and what you need to do before even sitting in front of a mortgage broker. So
So a lot of people that have similar to me have come and said, "Jaryd, I want to buy a property." I'm like, "Great, and they've got the savings, and they don't have just a couple of grand in the bank. They've got like like we said, if you haven't checked out our previous episode number 2, like how much you actually need for your first property purchase, it's around the 80K range. And we break down why specifically that amount. So check that out if you haven't listened to it. And once they get to that area, they're like, okay, what do I do now? And it's like, go and find out what your borrowing capacity is. And I guess there's multiple steps to be able to work out what your borrowing capacity is. It's speaking to a broker, which we're going to talk about in another episode on how to do your due diligence on a broker so you don't get taken advantage of, and you have the number one person on your team that's like a world-class broker. We'll teach you how to find them. But through the steps of finding the broker, there's a few things that they're going to ask you, and it's worth you having preparation and some paperwork in place before you go to them. So what are some of those things that we need to know that we've got to have with us before we go and speak to a broker?
Yeah, good question. Initially, I say, look, having 6 months worth of bank statements is quite important. You pausing there?
Sorry, I'd had to jump in there because I think 6 months worth of bank statements, that's for one particular type of buyer. Like there's going to be a few different things, and I think maybe we should explain that it may be different for somebody that is a PAYG employee versus somebody that owns a business. So when you said 6 months bank statements, I was like, oh, I wish it was that easy for some of us.
Yeah, for PAYG, it's a lot easier, right?
And so maybe we stick to PAYG, and then we move to like a little bit of self-employed.
Yeah, we'll jump around with both.
Okay,
but,
cool.
I guess the reason why I'm saying 6 months worth of bank statements is most banks, they're asking that from you anyway, and that's really simple to get. I mean, even if it was 12 months, or even you're going through a small business or a large business, they're going to be asking for all your BAS, your business activity statements, and all they're wanting to do is to understand what your income and outgoings are from a broad level up. So they're going to be asking for those statements. So just obviously be prepared for that. Really easy. Go on your bank website and go to your statements section and print out the statements that you need, that they're being requested. But they are going to be requested. So this is putting your best foot forward and being proactive rather than reactive. So that's the first one that I jumped onto. And I mean, they're going to ask you a lot of questions, right? About your expenses, your payments. So, I mean, we can talk about how to maximize your borrowing capacity in another episode, because that's definitely really important. I don't want to get too off track on that, but
expenses though, like what type of expenses are we talking? Rent or mortgage repayments, or like cost of living sort of thing? Is that right?
Yeah, so they'll have the questions that they'll generally come up are those ones that like say gambling, or if you're doing Uber Eats all the time, and there's sort of ways to go about removing those questions from that, and we'll talk about that in another episode. But recurring payments are a key one. Basically, they just want to understand, is this something that's going to be into the future or not with your bank statements. So sometimes they come up as a red flag and they just question about it. But obviously read through your bank statements just quickly and understand that if there are any questions coming up, you're kind of going to be on that front foot with your broker. And most of the time, no one's really going to ask you too many questions if it's pretty straightforward. So don't stress on that too much. The other section would be employment, and this is for employees, right? They're going to ask you for your last employment certificates, what we call them, the pay slips.
Oh, okay.
So I'm getting my mind back to when I was an employee, but so they're going to be they want a certainty around your income status, right? So that's why it's really easy with employees, because generally they're seen as more secure as opposed to businesses. But you and I would argue differently to that, because as a business owner, you can see what's coming in and going out, so there's more confidence. But banks, they want to put you in that little hole, and PAYGs, why they ask for those pay slips.
Also, sometimes doctors and lawyers have an easier time. I've heard can get better circumstances from the banks when they're going for their borrowing.
Yeah, that's a whole. Well,
That's another topic.
that's not really. I want to say whole other topic and just keep pushing people to the future. But if you are a doctor or a dentist, physios, if you've got that, like I call them recession-proof employment people, basically, they get better loan-to-value ratios. So most doctors, nurses, they can run off a 95% loan-to-value ratio generally. And obviously, this is all general advice, so you got to speak to everyone's circumstance is different, right? So speaking to a really good mortgage broker and an accountant is important at this stage. But you're right, they do. They have more favourable lending terms because they're less risky.
Yeah.
Everything from a bank perspective is assessing your risk. So keep that in the back of your head.
And banks and sometimes people will get frustrated with banks. And maybe I should change sometimes to a lot of the time, but that's because what you personally may think is risky or not risky is not what the bank considers risk. For example, you mentioned employees versus owning your own business and what's more risky. The banks have their own lens on how they perceive risk, and we're playing a game with the bank. So we need to play by their rules and accept it, I guess.
Yeah. They say property's a game of finance with a few houses thrown in the middle of it. So
yes,
you just got to play their game. It's just like tax, right? You got to pay tax, but there's more efficient ways to reduce your tax, and that's just the game of life, isn't it?
It is. What other things do we need to have prepped?
Look, when you go into a broker, getting your pre-approval, they're going to want to know, obviously, your income, your expenses, as I mentioned, but also if you have any other debts. So called HEX debt, HEX help these days, university debts, car loans, personal loans, anything on that nature, they're going to be seeing that obviously it's a liability and it's going to reduce your borrowing capacity. So your mortgage broker is going to be asking for all this stuff. So that's the whole purpose of this, is to say, look, be prepared. This is what they're going to be asking for, because you can just go straight to your broker, have all the information already as they've requested, or before they request it, and then it's just straight in, and you're going to fasten your track to a pre-approval and understand your borrowing capacity to get to where you want to be, which is purchasing the property, right?
Yeah. Exactly. And talking about borrowing capacity, our next episode is going to be on how to improve or increase your borrowing capacity. Maximize is the word.
Well, the last point on just that one, so we can sort of run into the next. It's quite similar, right? Like obviously your debts, but credit cards, buy now, pay later, things like that. If you've got that under your, your expenses, they're going to be asking for that too. So obviously just be prepared, having your credit card statements and all your, if you've got the afterpays agreements in place, they're going to be going through and looking at that. If you've got multiple afterpays, it's going to reduce your borrowing capacity as well. And I'll talk to you about that in the next one, about how to maximize borrowing capacity. And little spoiler, just cancel it, pay it out. Yeah.
So is Afterpay like one of those 50-month interest-free type deals? You know how they used to, I don't think it was Retrovision or some of the fridge shops. I don't know, I haven't used Afterpay, but is it like where you pay, sounds like you just pay it later, but there must be surely a crazy high interest rate with that.
Yeah, it's kind of like, nowadays, what was it called? It was, I don't want to bore people, but it'll come to me.
Okay, we'll talk about this through the maximising borrowing capacity.
But you're right. Basically, it's buy now and you pay it later. So you're paying off that debt. So say you want that TV, you go, I want that. They go, fantastic. You can have it today, and it's $1,000 for the TV, but you can pay us off, over the next 24 months. Generally, they'll have an interest-free period, which will entice you to go in and pay for that, and that's fantastic. The issue that I'm seeing is that people doing that multiple times, and they're just putting off, I guess, the repayment. So it's ballooning down in the
Their
future.
liability.
And after a few years of this whole buy now pay later thing, people are actually struggling because they've spent their future money essentially.
Oh wow!
So banks will look at that and they'll see that as a liability. You've got to pay that off. So
we're going to have more stories around that.
There's dangers around it.
Yeah, in the maximised borrowing capacity next episode. So, is there anything else that we see is important for prepping before we speak to the broker?
Yeah, last thing is they're always going to ask what your assets are. So looking at your, what properties you own, obviously you have any debts on those as well, but looking at your shares, what cash on hand you got, your superannuation balances, other investments. So basically, as I said before, they're looking at a risk assessment. So they just want to know everything about your financial situation. So just think of it that way. Whatever you've got in assets, they're going to want to know. They're going to want to know what your income is, and they also want to know what your expenses are.
Liabilities.
So it's kind of like a big profit and loss statement on your own personal banner. And based off that, they're working out what is your net cash flow and how can that support the loan we're about to give you. And they'll put a buffer in there in place. So if you've got a cash flow of $1,000 a week, you're lower risk. So banks will look at that and go, well, yeah, they can afford to pay $500 a week in interest. Therefore, we'll give them a loan up to X, reducing their risk. So your propensity to pay is high, and that's all they want to do. Just want their money back, and they want you to pay as much interest as you can over a 30-year period. So,
And we will have more episodes coming out about how to reduce your loan period and interest rates and pay your debt back a lot faster. If caveat that's the strategy that you want to take with your property portfolio versus fast growth versus different strategies, and we'll talk about that. I guess what we've talked about here is the most common way for somebody that's starting out to get finance for a residential property. But is there differences when you're buying a commercial property as well?
Yeah. With commercial, there's different loan structures as well. So,
because with commercial, what I understand, I haven't yet bought my first commercial. Is that they also look at the asset that you're purchasing in terms of what the lease agreement is, which can be used for financing as well, right?
Yeah, they've got lease doc loans, the low doc loans. Lease doc loans are less common at the moment, but it's always changing. So that's obviously the importance of having a professional on your side is that when you're in it every day, you know what's happening. And there's more, I guess, savvy ways of going about it. But overall, they do assess it because you're doing a commercial loan, not a residential loan. And commercial, the bank size is seen as higher risk. Some people would debate that, but if you look at history, in downturns, generally the commercial premises they can remain vacant for a longer period of time than residential. Having a bigger buffer in the bank size is important. So generally they run on like a 70% LVR as opposed to residential that can run to generally 90. As I said before, if you've got a higher income or a safer income, you can go 95. Back in the day, they used to do 100%, 105 even. They used to pay the stamp duty for you. So that's
different economy at the moment, guys. If you are interested in us talking about commercial finance and getting prepped for that and some more commercial stuff,
let us know.
Let us know. Email us at hello@propertypals.au. There's no .com, just straight up .au.
Just straight up Australian.
Yeah.
Yeah.
So we're going to stick with the theme of residential for now, just to simplify this episode. And later, if you guys want some more commercial advice or discussions, we are not financial advisors. This is not financial advice, so you will need to get all of this checked with your own personal situation as well, like we say in our disclaimer. So back to the residential thread of getting pre-approval. Where do we go to next?
Well, they're your 7 key areas that I mentioned before, those bullet points. So getting that in place is really important. You listen to this and go, oh, that kind of makes sense. And the reason why I want to say that is your mortgage brokers are going to ask you for that information anyway. So coming in more prepared, your broker's going to look at you in a higher regard because it's less time on their front. And they're obviously they're busy people, and the good ones are hard to get a hold of. So if you're going in initially, as you know, and they send you back to go and find all that stuff, it's just going to take an extra couple of weeks, sometimes months, because they've just got so much on their plate. So this is just going to save you time, fast track you to where you want to be, basically. But the next part of what I want to talk about is credit scores, and people don't know what that is most of the time, and that's completely fine. I didn't know either until obviously I got into property. But basically banks, they're assessing your, financial situation through a credit score. So each loan you go for, each credit card you apply for, it's all being recorded on a system, and that is what contributes to your overall credit score. So banks are basically on the back end assessing who you are as a person, and they go into a register to understand, are you safe or are you not? So if you've got multiple credit cards that you've failed on, then it's not going to look good, and they're going to either not give you a loan, or they're going to give you a loan with a very high interest rate or a very, high loan to value ratio. So your borrowing capacity is going to be really hindered. So understanding your credit score is really important.
Yes. Now let's talk about actually understanding your credit score, because I once got frustrated with all right, credit score, and people say you need to understand your credit score. I'm like, cool, but how do I understand it, and how do I find out what my credit score is? Seems like in America, I think it's credit rating, and you can find out personally how to find out what your credit rating is, and it's a basis points or whatever it is. But over here in Australia, from what I've learnt, is it's not as easily accessible for general population, unless I'm wrong, to find out what your credit scores are. When I was speaking to one of my brokers, they said there's a register or something. So tell me more about, can people personally go and find out what their credit score is themselves, or do they need to do that through a broker, or what's the go with it?
Yeah, listen on in. So there's a couple of key points to, run through. What the credit score key assessment points is what I call them. And then I'll jump into where to find this information for free.
Yeah,
so
sweet.
Let's have
that's good.
Love that word. So the assessment points, basically looking at your personal debt, in both past and present, to see how you've gone about either repaying that or not. If there've been any debt repayment issues, and then there's loan approvals and inquiries for personal and family reasons. So that's why if you hear people saying, don't apply for too many loans at the same time.
Yes, or if you've got a property not settled. Because I had this come up, it's like, I've got one about to settle. Can we set up and get approval for the next one? And my broker's like, no, we cannot, because it will tarnish or could tarnish me trying to get approval for the next one. So, you don't be like a rabbit like me.
Well, it's good that you do that, proactive, but if you're applying for loans, even if you don't go down that path. So that's why having a really good broker is important, because you'll have at each one time, there's hundreds of different lending products you can go down. You want to pick the best one and go for that one first for your personal circumstance. And if you do that one and then do the second best and the third best, you're putting 3 applications in, and that's going to be a red flag on the back end of the system. So it's just wise not to do that, because if those red flags come up, then that's going to affect your credit score. Okay, so don't do that. The other thing that I want to mention was just your credit cards and your current credit limits. That's all accumulated into your credit score as well. So that also encompasses obviously your retail store credits or your buy now pay later cards. They're also going to look at all your different bank accounts that are open and closed. So
even closed ones.
Yeah. It's quite interesting actually. I've had bank accounts that I've from way back in the day, like the first bank account out of school, and
what were you buying?
I was just hustling all those term deposits to try and get those high interest when I was younger.
Oh, is that a thing? They check that?
Yeah, they check most of the stuff, but I had one credit card that I actually applied for and I cancelled. It was obviously won't say the bank's name, but I thought I cancelled it, but in fact I didn't cancel the account. I
Cancel the card.
cancelled the card, but they still saw it as a credit account, and I actually had to go back, call the bank, and shut the whole bank account down. Which I thought I did that in the first place, but hey, I wasn't getting any fees, so in my eyes, I didn't have the account. So once you've closed all those accounts you're not using, the next thing that you want to obviously look at is any legal proceedings they're going to look at as well. I mean, obviously, if you've got a lawsuit against you, that's not fantastic. So you got to understand why, and then just let them know if that's a question that comes up. And then bankruptcy history. Most people don't have any bankruptcy history, but there's obviously rulings around that. If you do declare bankrupt, you're looking at 7 years before you can obviously go for loans in certain circumstances. Obviously, it's all different based on the level of bankruptcy and the issues that you're in. But obviously, talk to your mortgage broker and accountant around that. They'll give you more details. But the most important part of this little bit is, go and check your credit score. It's free. You can do it online or you can do it over the phone. We'll put some links in the show notes, but CanStar is a website, www.canstar.com.au/credit score. They'll do a free credit score check for you. So check that out.
Awesome.
There's also finder.com.au, same sort of thing. You can just go finder.com.au credit score, Google it, or do the / beforehand. Another great way just to quickly understand what it is just call up. There's 3 main companies that deal with it in Australia: Experian, Illion, and Equifax. So
what do they do? So you call them up and they'll tell you your credit score?
They're credit assessors.
Oh, okay.
Yeah. So they're the ones that you go to, and obviously you call them up. Any other sort of information you're looking for, just check out the government. Actually, the Australian government has some really good money smart tools and guides. I mean, they just don't market it, they don't put any money into it, but there's a lot of good free information on a website called moneysmart.gov.au. So check that out, and all the information's there. So ways to improve your credit score. I mean,
guys, links, we'll put those phone numbers and links in the show notes to all that sort of stuff as well. But yeah, I want to know how to improve the credit score.
Yeah. Well, it's pretty simple, right? There's a few key points. So I know I've dragged on about this a little bit, so it might be a bit dull for other people, but I mean, I'm always an advocate for you don't know what you don't know. So by understanding this, you're going to put your best foot forward. It's going to speed up the whole process, and you're going to have a much more enjoyable experience, because finance and property is a pain in the ass sometimes, and I've dealt with it so many times. And Jaryd is a classic example where we've been working together, and it's the one thing that's just, I'm going to buy a property.
Yeah.
I love
it's the biggest thing that holds people back, right? Is finance. It's the biggest roadblock to buying a property. And I know people that could buy properties but just won't, because it's I just don't want to deal with the banks.
Yeah. Oh, yep. Yeah. That's a classic one. And other people just say, I just want to buy everything with cash. And for me, you're not maximizing your borrowing capacity. And it's actually, by going cash all the time, you're actually hindering your portfolio growth and the compounding effects of it. But we can jump into that time. Basically, the key ways to actually improve your credit score is pay your bills on time, make loan repayments on time. Don't overextend yourself financially, so don't get caught in that, I guess that, what they call the hamster wheel of life, where you're just running around going nowhere. And dispute any, and remove any outdated information on your credit score reports. So they're not always accurate, and something might come up, like you didn't pay a bill on time, but there could be a reason for that, or you could have paid it and for some reason it's there. So don't be shy in disputing it. That's the quickest way to try and improve your credit score.
And you can dispute it, you can dispute it with, say, CanStar or...
Yeah, with Equifax and Illion and all those companies, you can actually call them up and talk to them and say, I don't agree with that for X reason. I want to dispute this claim.
Wow,
And
that's cool.
they have to go through the formal process and understand why. You need evidence as to why. But yeah, don't hesitate on having a go at that, because it's going to stay on your file for a number of years, right? So it's going to, it's going to rear its ugly head in the future if you don't do it now. So it's a bit of small-term pain for long-term gain.